All right, welcome to 3.2. So I just wanted to start off with what exactly is an IPO? What does it stand for once again? I'm going to ask you guys this every single meeting. What does it stand for?
Initial public offering.
Exactly, perfect. And it makes, or at least it signifies, a private company going to what?
Public.
Exactly, and what does it mean for a company to be public? Their stocks are on public exchanges, right? So that's the big picture here. If you understand that, all of these other things are going to make sense. The only additional thing I would like you to understand is the underwriting process, which we can go back to later just to make sure, at least prior to IBC Social 3, to make sure that everyone does understand what is going on. So in 3.1, we talked about why companies do IPO and the prospectus. It's important to remember that the initial public offering is, well, one, a method of capital raising, and two, a method of capital raising companies use towards the latter half of their private stage, right? Instead of an initial public offering to raise money, they're probably going to go through a few other avenues, like bank loans, or issuing bonds, maybe even venture capital. But once those avenues are dried out, then they're going to push to that initial public offering. And the reason is because in an initial public offering, you have to give up a lot of equity of your company. You might be allowing 30 to 40% of your stocks to go onto public markets, and that's 30 to 40% of the of your company that you do not have. That's why it's kind of that last avenue. So again, we talked all about why companies IPO and the literal document associated with an IPO last meeting. This meeting, we're going to talk about, well, how investment banks preserve that IPO. So one, we're going to talk about when IPOs fail, right? So what investment bankers shouldn't do. And then we're going to talk about what investment bankers do. We're going to talk about how they preserve that IPO, right? And then we're going to talk about unicorns, not the animal, but the business, or at least what a unicorn is in the business world. And next meeting, we're going to kind of pull a parallel to 2.3, where we're going to talk a lot about analysis and research and so on. If you guys can, just scan this QR code. Again, I don't scrutinize. I just like to know who comes to the meetings in case I ever need to, figure out how many shirts we need or anything like that. Again, this is the website that I just showed you guys that had 3 individual modules, the IBC project website. It's the website that our team has made to expand investment banking clubs all around the world. And so far, we've been somewhat successful in doing that. And now we're going to talk about failing initial public offerings. So failing initial public offerings make investment banks and bankers alike look bad. Why? Because it's investment banks that facilitate this initial public offering process. It's like a teacher teaching a group of students, and that group of students failing their respective test, right? That means that the teacher didn't do what they were supposed to do. And in that same way, if an initial public offering fails, that shows that that investment bank or those bankers didn't do what they needed to do. And this is where the offering price comes into play, because it's the indicator of how well an initial public offering fared. The price at which shares or stock are sold to initial investors. When the shares of a company do not stay above this offering price, it reflects badly on investment bankers. What does this kind of sound similar to? Well, we talked about it in Unit 2. It was the broken deal, right? A stock breaks when it falls below that offering price that's set by underwriters. We talked about this on the last slide of 2.2, if you want to reference that on the Google Classroom right now. But investors feel as though they overpaid, or investors may also feel like investment bankers didn't understand the business well enough. Because remember, it's important that prior to a transaction, or at least during a transaction, investment bankers do something called due diligence. That's synonymous to research. They just need to research their company. And a broken deal is, again, when the price of a share in aftermarket trading. What is aftermarket trading? What's the difference between the primary market and the secondary market? Could anyone answer that? That's a money question right there, because that will show that you kind of understand what underwriting is. And that's probably one of the hardest topics to understand in this. So the primary market is the market where stocks are initially sold. So you, assuming you guys are the general public, don't have access to the primary market. The only people, the only companies that have access to the primary market are, well, literal institutions, other companies, or accredited investors. In order to be, given the title of an accredited investor by the SEC, you need to kind of show your way around stocks and so on. They'll give you that title eventually if you have fared well enough in those markets. But me and you guys, we can't invest in the primary market. And primary market, or at least the institutions there, are the ones that get those fresh baked goods, those fresh stocks. So if we think about the underwriting process, we first have a company. Let's say Shannon has a RC car company and he wants to go public. Well, what he's gonna do, and right now I'm detailing the underwriting process, right? We've talked about this a little bit, but just to remind you guys, what he's gonna do is he's gonna go to an investment bank and say, hey, look, I've exhausted all of my other avenues of capital for capital raising. I want to consider this initial public offering. So help me with that. So the investment banker's gonna say, hey, look, we're gonna underwrite your shares. What does underwrite mean? It means take a financial risk for a fee. So they're gonna take the risk of buying the stock that Shannon wants to sell on the public markets. And there we go. Shannon's need for capital is alleviated, right? He sold that stock already. So he can kind of be quiet at that point. The only thing he has to worry about is, well, how does this stock fare in the future? Which is where we get to that broken deal portion. But anyways, now that investment banker has taken that risk of buying all that stock. So he also gets a nice fee, right? That's underwriting for a fee. You've added the two and two together. Now the investment banker is going to sell that stock. The investment bank is going to sell that stock on the primary market to institutions, to companies, to accredited investors. And then those people on the primary market are going to sell to the secondary market. This is where me and you come in. We buy on the secondary market. So a lot of the times when we buy stock, we're not buying it from that new company. We're buying it from institutions or people that have already bought that fresh stock from IPO companies. So that's something that you want to keep in mind. And it's this aftermarket trading that is associated with the NASDAQ or the New York Stock Exchange, right? Remember, you can only access those two financial institutions via a brokerage of some sort. Unfortunately, you can't walk straight up to the stock exchange and say, hey, give me some stock, right? We're not that special. Although you guys are, of course, all special in your own individual and unique ways. Anyways, the secondary market is synonymous to the aftermarket. That's why I went on that long tangent, right? Aftermarket trading is when stocks begin to trade on an exchange, NYSE, NASDAQ, etc. This corresponds to the broken deal. A broken deal occurs when that stock price set by investment bankers in the underwriting process. So when those investment bankers are selling to institutions in the primary market, they kind of also set the stock price somewhat for it to be sold in the secondary market, or at least they set a reasonable stock price that it's going to float around. And when it goes dramatically under or dramatically over that stock price in the aftermarket, that's when you can call it a broken deal, and that's when IPOs fail. Okay, so IPOs fail when the stock price that was set by investment bankers fluctuate dramatically. Okay? That's the big picture there. So now what do investment bankers do to preserve that IPO in the long run? Well, there are three things, and we're going to talk about these further in the coming slides, but this is just so that you can kind of remember them. Lockup periods. A period of time where the directors and officers of a company are prohibited from selling shares. This creates a natural equilibrium between buyers and sellers, and what it also does do is, well, not scare away new buyers of the company by seeing their CEO of the company they're about to invest in liquidate a ton of stock, right? That's scary. Those CEOs know more about that company than you do. But we're going to talk about that in a second in case you're confused. Then we're going to talk about quiet periods, which is a time where companies that are IPOing are prohibited from engaging in some kind of promotional activity. So that's interesting. That has a lot to do with the road shows we talked about a while back in 2.2. So if you don't remember that term, it's going to come up. Maybe you'll get a Jolly Rancher if you went, although I don't have a Jolly Rancher, so I'll have to do some kind of thing on that. I'll pay you guys back later. But it's a money question right there. It's a money question, so you better not Google it. Hopefully I haven't given you ideas. And then we have follow-on and secondary offerings. So again, the IPO is not the only time. It's not the only period in which companies then sell their shares of stock to the public. No. There are things after you IPO. They're called follow-on and secondary offerings, and there's a distinct difference between the two. So make sure to keep a mental note of that.
Alright, this slide is about preserving the longevity of IPOs specifically. This one's talking about investment banks. So investment banks help a company go public, but investment banks aren't able to affect what the company does itself. i.e. an investment bank allows the private company and facilitates it to go public, but it doesn't allow it to change like what the company does in the first place. So for example, it cannot change the way a company is run. That's the job of management, i.e. that's the job of the company in the first place. The next slide is probably more important. Now this one is about lockup periods. So as Ayan talked about earlier, a lockup period is a period in which the initial investors of the company aren't able to sell their stocks. The reason is because if the initial investors are able to sell the stocks as soon as it goes public, then it's going to crash the price of the stock. So for example, most companies or most private companies are owned by like 80% is owned privately, and then 20% would be owned publicly post IPO. Once that happens, if one large private investor were to sell a ton of stock, say 10%, that would completely crash the public stock price, and that's obviously horrible for both the investors and like the receiving end of that. So yeah, that just explains how like stocks works by supply and demand, i.e. if there's a ton of supply and low demand, then the price is going to be very low. So as if a company goes IPOs and then the private investors sell all of their stocks, there's going to be a ton of supply and the same demand, so the price is going to drop. 90, 180, and 365 describes the like certain periods in which describes when the lockup periods can be. So certain companies can have a 90-day lockup period where after 90 days, then these these private investors can sell their stocks. Other hedge funds, for example, might have a lockup period of like 30 days, and it varies.
And also, one thing that you might want to take note of is when we talk about insiders right here, it could be what David talked about, right? Those hedge funds, etc. But it could also be executives within a company or employees. And you might be questioning, well, if in the underwriting process, in order to sell to the public, like me and you, in aftermarket trading, well, these investment banks buy the shares and then sell them to those institutions, how are these insiders selling in the first place? And that's usually where we talk about secondary offerings and so on, and that's what we're going to talk about in the latter half. So keep thinking about that, and then your question will be answered very soon.
Alright, so continuing on what David and Ion talked about preserving the longevity of an IPO, we have the quiet period. So this is basically when a company is not allowed to promote the value of their company, and the main key importance of these quiet periods is that it allows a level playing field for investors and analysts on interpreting the value of the company. So yeah, basically regulators and investors, they don't want to invest in securities that they know aren't going to fare well, and they work together to control the information that is released about a company before an IPO comes out, basically regulating the playing field. Another thing, a prohibition. So this is when it's prohibited from pushing promotional activity about the value of an IPO. This doesn't mean that when they're on road shows, they can't provide like financial information about their stock, but they can't get promotional. So like make misleading promises about the value of their stock. They just have to be completely factual. And also a roadshow, a little side note, is just when a company goes from city to city, like giving presentations about what their company's about and like just financial facts about their company.
Alright, so we have two different types of offerings where they sell stocks after the IPO. So these are follow-on and secondary offerings. They're selling them to the public again to raise additional capital. First off, there's follow-on offerings. So companies are going to be selling new shares to the public. So these are not the original ones from the IPO, these are ones they created. And the risk of this is that you might actually dilute existing shares. So dilution is like, imagine you have an Oreo McFlurry and I just poured like a ton of water in it. Is the McFlurry still gonna taste good? No, it's diluted. So that's like the same thing. The shares are gonna lose value because then new shares have been created. And there's also secondary offerings, where these are the existing shares that are being sold. So it's not going to dilute the shares, because they're already sold to the public in the IPO. They're the same ones.
And is everyone familiar or okay with the concept of dilution? So I just want to illustrate it a bit further, right? Like, let's say we have 100 stock, and each stock is valued at $1. Well, technically, if we were to talk about the market capitalization of this company, which we know, hopefully all of you guys have remember the formula, right? Just shares outstanding times the price of the company. What company right now has the highest market cap out of all companies? Microsoft.
No,
There we
Apple took
go.
it back.
Apple took it back? Are you
Apple took it
serious?
back, yes.
No way. Okay, that's crazy. That's like the fight between Bernard Arnault or whatever versus Elon Musk. They just like keep topping each other in net worth. Am I wrong? Okay, whatever. So yeah, let's say that the market cap of this company is $100, right? Because we have 100 shares of stock and then $1 per stock. And this company decides to do a follow-on offering where they create 100 new shares of stock. But they still want to retain that same market cap, because you can't just say, oh yeah, I'm going, or actually you technically can, that would be secondary offerings. But in this scenario, let's say they have the same market cap. That means they now have 200 shares of stock with that $100 market cap, meaning each share of stock is now worth 50 cents. So imagine if you initially, before the follow-on offering, had 50 shares of stock within that company. That would be worth $50. Now, with the new stock they created, it would only be worth $25. So you can see how damaging this can be to investors. And then with the secondary offering, it would keep that, it would add on to that actual market cap. It would add $100 more onto it. So yeah, big difference between the two. Thank you so much, guys. Thank you so much.
Alright guys, so now you got a unicorn, right? This isn't a real unicorn? Well, it is a real unicorn, but not the way you think, right? It doesn't have a horn. So this is just a company, a private company that has a valuation of $1 billion or more. Some companies may resist going through an IPO for many reasons. They have investors that are patient and are looking for the company to grow. They're just, they're playing the waiting game. They don't want to worry about the requirements of a public company, right? Like the public companies have more restrictions than private companies. They gotta do like more reporting and all that. It's just a little bit more of a hassle for public companies. So just constantly disclosing private information. And some examples are Uber and Slack. Uber had a valuation of 8.1 billion, and Slack had a valuation of 7.4 billion whenever they went public. So you'll learn about, you'll see a chart of a bunch of private companies.
And, just to harp a little bit more on what Nicholas said, right? Some companies may resist going through an IPO for many reasons. We've talked about these reasons, but let's look at them in aggregate now. Sometimes you have investors that are okay waiting the long term. Sometimes companies will go public because investors decide to be short term and just want to liquidate really fast. What does liquidity mean? Or what does it mean to liquidate? Right? It's how fast you can turn an asset into cash. So those investors are trying to turn all of their stock into cash really fast and are trying to sell to the general public because it's easier to sell to the general public. You have more of them. So that's one reason a company may go public. And I mean, there are many more. And I was looking at the inverse of that, right? As to why a company may stay private. It has a lot of those long-term investors as opposed to those short-term investors. Another reason a company may stay private is because, well, they're fine not sharing their financials to the public. They don't want to share their financials to the public. When you are public, when you're a public company, you have to share your financials to the public via Edgar, the SEC's filing database, right? And that's kind of like showing your report card to the world. Sometimes you have A's, sometimes you may have B's and C's, and you may not want to show that to others, right? Same thing for companies. And also remember how the valuation of private companies can be super volatile. We talked about that in the beginning of chapter 2, I think 2.1. We talked, beginning of 2.2, we talked all about the gamble of private business deals. Tumblr was worth like 10 billion when it was bought, and then it was sold for 5 million. So it's pretty crazy, right? You lost so much money off of that transaction. And lastly, these are some international unicorns. This was created 9/1827, so it's kind of old. But you can see how many there are during this period of time. A lot of these companies, I'm sure, are already public too. It's kind of funny. No, never mind. That's Kickstarter. That's different. Yeah, I can't really take note of any of these companies right now, but a lot of the companies that you may interact with daily are private, and you may not even know that. For example, Reddit. I think I talked about Reddit going public soon. They're going to go public in March. So that'll be interesting. Make sure to read about it. Tell me about it. I'm going to read about it too. But it'll be an interesting point of discussion now that you've learned so much. You can actually apply your knowledge, right? Anyways, that's it for today. I'm going to give you guys a quick tour of 3.3. And if you want to scan the link tree, you can, although I'm pretty sure all of you guys have. So during 3.3, we're going to learn about the tasks of the sell-side analyst, and we're going to learn about research reports. So research reports are those reports that you look at that are created for individual stocks. A lot of them will have a star rating on the top, like a Yelp review, and it will say buy, sell, buy, hold, or sell. Those are the recommendations created by the analyst, right? Because they've put a lot of time into researching this company and its respective investments. So we're going to learn about where sell-side analysis comes into play, when companies turn to IPOs, being the prime candidate for an IPO, what investors want from sell-side analysts, how sell-side research is distributed, the research report, sections of a research report, and how to best use the research report. So yeah, thank you guys for coming, and I'll see you guys next week. Thank you.